So, good evening, everyone. My name is Dipayan Kothari, and I take care of equity and alternate products at Edelweiss Private Wealth. Thank you for taking out time for this session on market strategy post US election. I hope all of you are safe and healthy. Last week, we saw the counting of US elections, and while Joe Biden had emerged as the leader, Donald Trump refuses to concede defeat. Another interesting thing which we noticed was that whether it was Trump who was leading initially or Joe Biden taking the lead subsequently, or it turned out to be a contested election. In either of these scenarios, the market just kept moving up, and as we uh, stand today, even if you look at the domestic indices, Nifty 50 is closer to 12,750 levels. So obviously, there are other factors also contributing towards it aside the US election results. So, we thought of having this webinar to understand what are the implications of the US elections which has undertaken. So we have with us Mr. Shiv Sehgal to introduce him. Shiv is the President and Deputy CEO and co-head of the Institutional Clients Group. In his role, Shiv provides leadership to one of India's largest equity franchises and is responsible for capital markets businesses, and this includes institutional equities and asset services. Shiv will share his view regarding the outcome of US elections, key takeaways, what should be the market strategy, and what would be the key catalysts going forward. Before I hand it over to Shiv, just wanted to share with you that you have a Q&A window on your screen where you can post your questions if any. Once Shiv is done with his presentation, he'll try to answer the questions which you have posted. So Shiv, over to you now.
Thanks, Dipayan. Am I live? Can you hear me?
Yeah, Shiv, we can hear you. I'm just sending you live.
Perfect. Thank
You're
you.
live, Shiv. Yeah.
Thank you. Thanks for the kind introduction. Hi, everyone. First of all, thank you, everyone, for your time. I do hope to bring some clarity into our thoughts and how we are seeing the world, especially given the recent developments. I guess almost with the US elections outside, I say almost because we'll have clarity emerging very soon that Biden has won the presidency and will be taking oath on 20th of Jan. Plus the positive news of the efficacy of the vaccine that's out in the last, I would say, 72 hours. It's been a change of the guard in terms of markets narrative. Whether we like it or not, it seems the S&P 500 are trying to break out of the double top of 335.50. We have seen a very robust rally in emerging markets. Nifty has broken out of its year-to-date highs. Some of the key emerging markets are also seeing decent inflows in the last 2-3 days. And what's changed is that we have new leaders emerge in terms of sectors that were leading the market narrative. And, I guess since the beginning of this week, we have seen some of the bombed out sectors, the laggards and small beta in developed markets, especially at least lead the gains. And basically what's happened is that we have been seeing an unwind of the lockdown rally. Something similar to the trend that lasted from March onwards is being unwound as we speak, especially this week. And we have discussed this in some of my previous webinars as well, and how, since basically lockdown, we have had the big cap tech stock, which is the FANGs, and the Netflix, the Amazon, the Googles, and Facebook, and everything related to the cloud computing, outsourcing, SaaS, and especially in FMCG, the essential plays globally, seeing the bulk of the flows into their stocks. And I guess what's changed this week is that, we've basically seen some profit taking in some of these themes that have been playing out in the last couple of months. And we have definitely seen, especially in the developed world, some of the small cap stocks, which were sort of being priced to fall into an economic depression kind of valuations caused by the COVID lockdowns. There's definitely an interest back in these stocks. And we are seeing is a retracement of the trade where small caps, the epicenter pandemic industries making a decent comeback. We have seen airlines, travel, retail plays all having a very decent run up in the last 2-3 days. And with the news of the vaccine, it's probably been a flip of the switch suddenly that we have seen on Monday. And there is interest to own some of these stocks. And there's a massive rotation underway. Even today, we saw that in the Indian markets and the region as well. So I guess to me, it seems the reverse of the trend. And markets were kind of apprehensive going into end October as the second wave of European COVID lockdowns and viruses and the kind of spike that we saw in US and Europe. And we were seeing markets being a bit skittish into end October and going through the election process. There was a complete change in narrative on Monday, and markets have done a complete 180 degree turn. And before I go into the presentation and share some of the charts, I just thought I was when Dipayan and the team asked me to relate my thoughts, I just kind of went through a list in my head as to what has actually changed in the last 3 or 4 days, and what's changed the narrative, and what are some of the factors that we see some of the the changes developing. So if I could just list them out, I think the first and foremost that we have seen in India especially is that the biggest laggard, which was the financial, and that's the largest weight in the Nifty, has found new momentum. If you look at the HDFC Twins, the ICICI Bank, Axis Bank, some of the NBFCs like Bajaj Finance being back in vogue. Bank Nifty from September lows is almost up like 40%. And while it's still not, unlike the Nifty breaking down into new highs, we have seen that earnings, especially from some of the banks, it has kind of dissipated some of the narrative that concerns investors had in their mind in terms of NPS blowing out. And that's a very broad development, a very positive development for the Indian markets. The second element of what we are seeing globally is that last couple of days, there's been a complete change in terms of growth stocks seeing a lot of profit taking and a lot of inflow coming into value outperforming growth. And we haven't seen that since basically the beginning of this year. And that to me is a very important element to notice. How much of that is actually just a short-term blip or that kind of continues would be interesting to watch. But those are some of the factors that we are watching. As I mentioned, if you look at some of the momentum stocks globally as well, and just for people to kind of watch globally, there's an ETF in US, an iShares ETF called MTUM, which is basically got the bulk of your momentum trades. That the ETF is up almost like 83% year to date. And we have seen an unwind of that profit taking in that ETF as well. And that just shows it's basically reflective of what's been transpiring in the global markets in the last 2-3 days, especially in momentum stocks, especially like Reliance, which had a phenomenal run in the last couple of months. We have seen some profit taking there as well in Indian markets as well. So as I said, FANG unable to catch a bid this week. So big tech is suddenly out of favor. Another twist I am kind of watching is the sudden momentum in or back in favor in the energy sector, which is seeing some great performance. Don't forget, it was a completely bombed out sector past few months. Some of the interesting market participants and some of the smart guys I'm speaking to are talking very positively. And I think, as growth normalizes, energy is a sector to watch out for. As we talk about energy, so is commodities. Commodities are sending a very broad message across the board. We are continuing to see a breakout in some of the Bloomberg commodity indices as well. A similar trend in India as well. We have seen Tata Steel had a phenomenal run last couple of days. I think the stock's up like 15%. And that narrative is actually pricing in some sort of reflation coming back into global growth. Another aspect that I've keenly been watched this year is the relative valuation of Nasdaq to S&P. If you look at the relative valuation in terms of those two indices, you will realize that we kind of broke up in terms of Nasdaq versus S&P around 2.73 levels, and the last 4-5 weeks we've been kind of consolidating around 3.4 levels. And I'm starting to see a dip back into Nasdaq and some profit taking back below 3.4. I think if that consolidates further, that will kind of reassert our theme and our view that the big tech is actually seeing some not just a short-term blip profit taking, but this could be slightly more cyclical in the next couple of months as well. So bottom line, I think the market suddenly has ignored all the bearishness that we were seeing end October, first week of November, As I mentioned, with the second wave of COVID cases arising and spiking in Europe and US, the numbers getting reported were staggering. We were especially in US, we were above 100,000 cases. And I guess with politics taking center stage, people of markets have definitely ignored that fact. But it'll be interesting to see how much of the narrative is actually changed with the announcement of the efficacy of 90% of the Pfizer vaccine, and logistically when that can actually come to in terms of implementation. That remains a big question mark, and we'll see. We have kind of following closely as to how that builds. So I think with that, I would go back to my earlier narrative when we had initially spoken in the webinar, that with the levels of monetary intervention, no one could have thought at the beginning of this year, that with interest rates near almost zero in most of the developed world, and now further promises to keep such an aggressive intervention for years to come. Fed has basically said that rates will probably stay at the zero bound for the next 2 years. Money supply growth in US and most markets is actually hitting new highs every month. A very similar case in India as well. So it seems to me that gone are the days when Fed was primarily concerned with price stability. Jeremy Powell in the last couple of weeks has actually come out, who's the chair of the Fed Reserve, has recently announced that Fed had unanimously adjusted its sights higher to a more flexible form of average inflation targeting. And what the Fed has in fact said is that they want to target inflation that averages 2% over time. And anyone who's been following the macro stats in the US, we are far from that 2% inflation target in the US. So that basically means that we are probably going to be at a zero bound and no rate hikes coming for the foreseeable future, which basically means that the Fed will continue with its QE money printing of almost $120 billion a month, which is nearly almost 1.5 trillion a year. And that is why I think Dipan made a comment that irrespective of whether Biden was leading or Trump was winning, the markets kind of kept gradually grinding higher. And that's because the markets were pricing in irrespective of who wins, you are going to get a stimulus. And I think we are probably closer to the end of the calendar year before pre-Christmas. I think we'll probably see some announcement to the tune of maybe a trillion or 1.5 trillion stimulus getting passed. And similar thing is happening in most of the developed world. Last week we saw the RBA come out. They have announced 100 billion Aussie dollar QE program. The Bank of England has announced 100 billion pounds program. So we had a March, April, May, June. We saw all the central banks acting in consortium. Then we had a bit of a lag, and as we are approaching the end of the year and cases have again spiked, the economic recovery kind of stalled, and we are seeing the central banks again kind of come take center stage and kind of revive the markets. So bottom line is, interestingly, if you see all the money growth supplies, as I mentioned, we are not seeing the M2 supply growth since World War II era. And that's a very positive statement. We are talking about 60, 70 years of money supply growth in terms of charts. And that is a very positive narrative for emerging markets in particular, because what happens is as developed markets print money, the first element of that goes into developed markets, but then investors chase yields, and yields are only in emerging markets, like markets like India. So let me just kind of quickly just share some charts which gives you a broader perspective of some of the thoughts that how we are seeing the markets will play out in the next couple of months and quarters, and the short term and the long term narrative as well. Let me just share my presentation here. 1 second. So as I mentioned, I don't want to repeat this stuff, but I'll just kind of rehash. You've seen a massive expansion in the Fed Reserve balance sheet. The stimulus has been unprecedented, as we all are aware. We have heard this term being used to the hilt by most media and financial market gurus. So don't spend too much time on this. Rates have been cut to historic lows. Bottom line is most of the developed world is zero or negative rates. That to me has probably been the biggest kicker to equity valuations. US 10-year yields. I think this is one chart that I've been following very closely, and most of the macro guys kind of call it the chart of the truth. If you look at it from a 30-year perspective, this is extremely interesting that every time we have seen a blip in financial markets, basically there has been an arsenal that Federal Reserve and FOMC have had, and they have cut rates. We've seen that in 2000 with the tech bubble, we've seen it in 2008 with GFC, and we have seen a similar trend right now, as you can see in the last circle there. And for everyone following this presentation, we'll have this entire deck of charts sent out to you, and it'll be available on the website as well. So don't worry about it if I kind of rush through it. But I just want to kind of make sure that we all get as much as we can in this next 30-40 minutes. The next part is, I've spoken about this in the past as well, and this plays out into our view that why emerging markets will see the inflows in this decade. And that's the reality, is that large part of the developed market is dealing with negative yields. In terms of just some numbers, there is almost a staggering $14 trillion in global bonds that have negative rates. And that's almost 30 to 40% of the global tradable bond universe that is actually providing negative yields. And that provides a big kicker to markets like India, where you can actually, even though someone involved in watching the savings rate, we've gone from 10% to almost 3%. The reality is that in corporate bond in India, you're still having decent yields compared to the most of the developed world. So this is just giving you some snapshot in a pie chart. 90% is yielding less than 1%. That plays out very well into my bullish theme in India. And I don't want to spend too much time on the fact of where things lie macro-wise. We have spoken about at length in previous seminars. And if there are questions on it at the end of the presentation, I'm happy to take it at the end. But what I do want to spend some time is on how this US election plays out, and some interesting stats regarding that. So if you look at this particular chart, right, democratic regimes, which is what Biden's party is, right, it's always been generally far better for markets than Republican regimes have been in terms of US markets. The stats are here, but it's been a similar theme if you kind of outlay that and extrapolate that in Indian markets as well. Democratic regimes have created almost a 13 CAGR rate, which is an excellent result historically, right? And you're probably seeing that play out in the last couple of days as well, with Nifty up staggering, almost 3-4% in the last 3 days alone, and the bank Nifty up almost like 5-6%. So this to me is markets are, question was, why are markets looking at this positively? Markets are aware of the policies that democratic presidents and the senates have brought into, which have been very market friendly. So even though a lot of market participants are saying that Trump especially used to be tweeting out there and talking about how now Nasdaq is making new highs, the reality is that if you look at a 50-60-year-old trend, the democratic regime has been far favorable to capital markets than a Republican regime. So this is an interesting stat. Just thought it's interesting to just kind of outlay that at the open in terms of how this plays out and how markets have looked at historically. The second is, although they typically raise taxes, right? We have talked about in terms of Biden policies that how he talks about wealth and equality, talking about raising taxes. But the reality is that even though democratic regimes have raised taxes, they have also been very beneficial to markets. The other element is, as I talked about, right? This is just a chart of how India has played out in democratic regimes, and India's trade deficit has always improved drastically in terms of democratic regimes as well, and this is almost like a 30-40-year-old history. But before I get into that, just outlaying, a lot of you will ask, what does a Biden win mean for Indian markets? So I'll just preempt that question and just go through my narrative here. The important thing here is, what are his policies going to be towards emerging markets? What are they going to be towards India? And that question has huge investment implications. Are we going to see very favorable US trade policies for India? Number one. Number two, as I've already mentioned out, the Federal Reserve's low interest policy will probably continue to see inflow of cheap capital into the Indian markets, right? That's a very important element in my mind. Third is, will the Biden presidency and the US government regime continue to provide geopolitical support if and should we have broader standoff with our geopolitics with Pakistan or China. I think that's a very important element there as well. And lastly, I'll just summarize with a very simplistic version of what does the US government mean in terms of favorable visa policy, in terms of corporate India. While Trump had made a lot of noise against H-1B visas, the Biden regime has already made some snippets that they are pro-growth, and I think that will play out in what we've been seeing the narrative in terms of the Indian tech companies as well. So to me, what is really important is what are the Biden policies going to be towards India? And history suggests that Democratic have always been very favorable to India as they've been to capital markets, which gives me a broader perspective as to how the next 4 years can play out, right? And if we can get a combination of these 3 or 4 elements that I've spoken about, and as money flows into emerging markets, Indian capital markets stand to gain a huge advantage. The other thing that I am looking for, and I don't have it on a chart, but I just thought it's interesting to kind of lay out is, what does Biden signal in terms of choosing his team? Things like his Council of Economic Advisors, the National Economic Council. These are things that are very important for market participants. I'm also looking to see who he picks up for his Treasury Secretary, because that will provide a really major signal to the country and corporate America and India, and how he thinks about business, commerce, and capitalism. So those are the few things that I'll be looking into as he makes these announcements between now and January. Just moving on in terms of charts, what does the market factor in terms of crude oil? Now, last couple of days, we've seen oil up almost 10-20%. Don't forget that oil has been a big catalyst for India in this COVID lockdown. The fact that kind of growth stalled globally, but there was a big kicker in terms of our macro narrative that oil was stuck at between that $30 to $40 range. Now the issue here is that even the bulls, in my mind, have accepted demand has not recovered as they had hoped. I think they're starting to realize that OPEC is in a desperate need for cash. That's probably evident in people who've been following this market. Last week, Iraq came out and which is OPEC's second largest producer, warned its economy is threatened with a collapse. And my view is, and just speaking to some market participants, I believe that the Biden will probably further increase the pressure. In the short term, we can probably see a pro-growth rally in oil, but I think on the demand side, he's already mentioned that he will join the Paris Accord, and he has published a plan to achieve net zero by 2050. I think he's also very likely to follow the Europe in promoting a green recovery deal and increase support for electric vehicles and renewable energy production, which is a lot talked about in his clean tech development. And in geopolitics, I think he will likely aim to revive the Iran nuclear deal, which could probably be not many market participants are expecting, but which would lead to increased Iranian crude exports and probably put more pressure in difficult position for Saudi Arabia and the likes. So my view is that oil probably remains in a benign regime in the next couple of quarters as well. We may see some sporadic rallies, but I don't see oil going back to 50, 60 in the near term anytime soon. And just moving to the next chart, a lot of time, a lot less focus goes on, especially in emerging markets like India, from a macro narrative as to what would be the direction of the US dollar. And I think this one question alone has probably the biggest investment implications in markets like India. Our Kapil, who's our lead economist, has done a lot of work on this, and I have very high regard for his values and his thought process. And I concur with his view that we're probably entering a decade where, given the amount of enormous QE printing that has happened this year, it is not reflective in the USD weakness just yet. But watch out for 2021. Our view is that in the next couple of months, we will see a significant change in the dollar trend, and that will have serious implications for emerging markets like India and just broader EMs as well, but more so in India. And the reason I say that is, most developed market participants, when they talk about emerging markets, it's always been in the last 10 10-15 years, it's been about BRICS, Brazil, Russia, India, China. And within that spectrum, Brazil has been a completely out of favor market this year. They've not handled the situation really well. The Brazilian real has been a currency that's depreciated almost 25-30%. So that's an emerging market that's completely out of favor globally. In terms of Russia, a lot of their linkages are with oil. So that only leaves China, India. And I think this is the decade where both these markets will continue to outperform bulk of the emerging markets as well. So my view on the US dollar is simply based on the fact that the Fed will keep printing until it gets its way in the longer term. And given the enormous printing, whether the demand for dollar abates or not, that may start to happen in the next 6 months. But as the US dollar starts to weaken, it will have serious implication on investment decisions the world over, and a lot of inflows will come into markets like India. And as we talk about the US dollar, a lot of people out, which is the kind of direct correlation in terms of which asset class is about to win. And I've spoken about this in the past as well. And I just think I'll just rehash very quickly. I've been a big gold proponent, and I think this decade gold continues to see a lot of significant demand, not only from central banks, but a lot of money that is sitting in the reserves in US dollar will also shift into assets like gold. A lot of financial institutions will, in the 1970s, gold was a very favored asset class. If you spoke to any of the financial institutions, 5 to 8% of their portfolio allocation used to be in gold, which is today less than 50 bips. So just that stat alone gives me a lot of belief that gold can continue to outshine in the long term. So it's an asset class that I recommend everyone have in the portfolio for this decade. These are charts that we have spoken about in the past. As I said, and we remain very bullish on gold as well. And this I'll just spend a minute here. I've spoken about it in the past as well. In terms of previous bull markets in gold, you can see the red line here. The current bull market is not even started, right? I think this asset class can give a significant rally in the next 2-3 years. So it's not an investment that you watch every day or every week or every quarter. I think it's an asset class that you try and invest passively and just hold it. Not dwelling too much into it, but we remain very, very, very bullish on gold. So just my advice: watch this space. Continue to have an asset allocation to that space. Again, another chart which we are talking about, the dollar weakness augurs well for overall EM equities. And in terms of the money supply, I've spoken about this. The stat in the US is almost at 70-year highs. It's been a similar trend in India. It's been a similar trend in global markets. And I think this continues for a while. The fact that we have seen so much liquidity printing, this is something to watch out for. And I think a lot of this money has flown into equity markets as well. A lot of people have asked me, are equity markets priced in? We are seeing lofty level valuations. Does this abate anytime soon? I'll answer that question a little bit later as well, but I think this is a trend that continues in the near term. Moving on, yes, equities are expensive relative to earnings and historic valuations, but as I mentioned, relative to the money supply that we have seen, that stat alone, we remain far from being outstretched. So I think you'll be surprised how much broader markets can rally before we can see a real, I think this dichotomy between money supply growth and equity valuations kind of disperse. Just some very quickly in terms of what's transpired since March. Yes, we had the fastest decline, and we have also had the fastest exit in terms of the market narrative. So if we were too bearish in March and April, the FOMO trade has continued to play out. My view remains that the pain trade in markets is higher, especially going into first quarter next year and calendar year, new year. And, by all metrics, we have, as the economies open up world over and normalization continues. Yes, markets are factoring in a lot at the moment, but I would still be extremely bullish into why this rally kind of continues, at least in the short term. Moving on, just some narrative that I spoke about earlier in terms of the concentration that we have seen in most of the broader markets, starting with the Nasdaq and the US. I think some of this narrative starts to unwind, and we have started to see that this week as well, where FANG stocks are seeing some profit taking. They're at very lofty valuations in terms of the concentration of passive money coming into these selected group of stocks. And it was not just a Nasdaq story. It was a Japan story. It was a China story. It was a Germany story. It was an India story. This is a chart just to show that 5 stocks provided almost 47% of the returns in the Nifty. I think we probably see a dispersion of these performance metrics as the rally broadens, as we have seen in the last couple of days. So I would see as rotation happens out of some of these leading stocks into some of the laggards, you will see a broader based rally into the next 1 quarter at least. Dollar weakness, we've already spoken, not going to spend so much time. In terms of the US markets and what it means with the Biden win, bottom line is, I think a Biden win, particularly if accompanied by a win in the Senate, would have been a major change in the fiscal and the social and the industrial policies, given the fact that it's still not a majority win in the Senate. Markets are pricing in the fact that it will be harder for him to raise taxes at least in the short term, and personal taxation as well. And so overall, it's a very healthy mix for capital markets. Markets are already kind of showing their hand in that perspective. The one thing that I would say is that Trump's support for fossil fuels was one of the key themes over the last 4 years, but in Biden's, it will be all about that those policies redirected towards decarbonization and transport and power generation and clean tech energy. And in that regard, if people follow that space, if you look at the clean tech energy ETF, which is the iShares ICLN, year to date that index is up almost 83%. That shows the market were already factoring in his policies, but I would expect that trend to continue in the next 4 years as well. Also, as I already mentioned, Biden will probably not share Trump's obsession with higher stock prices. He'll not be out there, tweeting every time the Nasdaq or the S&P is making highs, suggesting kind of less pressure on the Federal Reserve to support the markets in terms of, whenever we do see pullbacks in the next couple of years. And that brings me to my next point, where, a lot of people have talked about the volatility and how that played out in 2020. Yes, in March, we had this huge spike in Feb where VIX index went up to 80. It was a similar trend in India as well. But just in general, right, I just want to let this audience know that, VIX has been in a very downtrend regime in the last 4 or 5 years. This is a much longer term chart here. We have had the one-off spikes every 6 months or 9 months where VIX has kind of gone from a 10-ish to a 35, mid-30s level. But my view for 2021 is that we are nowhere out of the woods in terms of the COVID narrative. And just globally, given the fact how much intervention has happened from central banks, I think we are entering a period where volatility and pullbacks could be much sharper. And the fact that we have had this long uptrend in terms of markets since March, I think, yes, we are bullish, and I remain extremely bullish going into the new year. But I also remain very cognizant that we will probably see a much, heightened volatility regime in 2021, which I mean that, your buy and hold strategy will probably be, a trading mentality might serve you better in 2021, especially in the first couple of months is my view. Moving on from there, in terms of, I'm cognizant of the time here, in terms of, we want to leave some time for participants to ask questions. But just in terms of India, right, why we remain bullish, what has been our thesis? The broader narrative remains around the 4Ds, right? And what are the 4Ds, which everyone on this call will probably be aware? I'll just rehash it. We remain extremely bullish on the demographics of India, right? India is one of the few places which are adding very aggressively to a labor force, which can play out in our manufacturing and our services index. I will not dwell too much on the macro narrative. I mean, most of us are aware of the broad thematics, so I'll quickly run through them. But to me, demographics, very bullish. Debt, the fact that we have not done the fiscal that markets wanted or market participants were expecting, gives us the RBI and the central government a very strong hand going into the new year. And I think, while there has been a lot of chatter of no new fiscal stimulus is coming in, I wouldn't be holding my breath. And I think irrespective of that, markets have held up very well, and that probably theme continues. Our current account, our fiscal deficits are in a very healthy space. So I would not be, the global markets are also perceiving this very positively, is what my point is. So that is not an issue going into the new year. We have had a significant amount of deregulation and reforms in the last couple of years, the fruits of which we will start to bear. Slowly of them are trickling in. A lot of positive press has happened both domestically and internationally on this. We've had the corporate tax cuts, we've had RERA, we've had the labor market reforms, we've had the land reforms. There is a plethora of broader themes that the government has done, and I think most of these things take time to play out in a market like India. But we are probably that, along with the fact that corporate India has really been curtailing costs in this COVID lockdown. I think profitability levels, as we have seen into this earnings season, play out very well going into the next couple of quarters. And lastly, just in terms of already spoken about the expenditure reforms here, and the last of the 4Ds is democracy. India is probably one of the best institutions here, and in terms of just giving people perspective on how this earnings season played out. Yes, the macro has definitely shifted for the better. Economic activity bounced back very sharply in September and October. We have had exports leading the way. We have had GST collections hitting new highs. We have had the PMI manufacturing in India almost at a 58.9 reading in October, which was almost a decade high. Not much has been spoken about it, but that was a 10-year high that we had in the October PMI. Yes, some people will say it was pent-up demand and normalization is happening and is at play, but the reality is these numbers are very robust. We have seen, almost regarding sectors, large upside surprises in cements. We have talked about, how financials have started to outperform owing to lower credit cost guidance. The large private sector banks are reporting very healthy numbers with stable asset quality figures. We have had sectors like pharma and FMCG where there's been a speedy uptake in demand revival. The tech sector since the start of COVID has been one of the highlights in India and has performed as expected. Yes, there's been some profit taking of late, but these companies have reported very healthy top line, and this is a multi-year theme for us. And overall, we remain very cognizant that there is a sharp upswing happening in economic data. The rural economy in India has held up really well. Our channel checks are reporting those stats, and that are also evident in most of the companies that people have followed in this earnings season. So bottom line is, the Indian economy is clearly getting back on its feet. I mentioned, let me just, kind of, stop here in terms of the presentation, but just some healthy stats. India has been a strong outperformance track record lately versus MSCI EM, and I think this continues into this decade. It has delivered high earnings with low volatility. I think volatility will be a bit high, but earnings will remain. And let me just go live here and kind of click the presentation here. So, just few things to highlight. I think, lower rates in terms of global markets are a permanent theme for the next few years. That's a very structural positive for equities. We have stronger balance sheets in corporate India today. There has been a robust cost control, lower taxes augur very well for profitability in India. We've been talking about the low corporate profitability ratio versus India GDP. It's been an all-time low. I think as we enter the next couple of quarters, that metric alone will start looking very healthy. And the fact that after 10 years of underperformance of equities versus bonds, a revival in corporate profits should turn the tide in favor of equities, especially EM equities in India in the next couple of years. And just overall, few stats. India and China are the only markets year to date which have continued to see inflows from foreign perspective. India today has seen 9 billion worth of inflows, And anybody who's been following the recent developments by MSCI, they have increased the free float calculation weightage in India. And at the end of this month, India is going to see another $3.2 billion worth of inflow from foreign institutions. These are staggering numbers, right? The fact that only India and China are the two markets that continue to be, in favor by passive money flow and developed markets is a very healthy positive. India weights in the MSCI goes up from 8% to 8.8. Indian markets in July and August, we recovered over the 2 trillion mark. I haven't checked lately. Last week, what we're probably at 2.3 or 2.5 trillion in terms of market cap. And the impact on consumer and corporate behavior, for example, is I think, while difficult to predict, I think some trends have clearly emerged, and savings appear to have gone up recently, as evidenced in the current account surplus, which suggests that private sector is saving more than the government sector deficit or saving. But I think capex is something that we are watching. It has been on the slow trend in India, but the market commentary suggests that it's coming back. And what has been the biggest catalyst in this earnings cycle is that most commentary coming out of corporate India is that yes, last 2 quarters it was all about cutting costs. The next 2-3 quarters are all about growth, and that really plays out into our bullish theme. And yeah, I'm aware of the time here. Sorry, I've spoken for about 40 minutes. But I guess I'll stop here, and happy to take any questions that I am from market participants.
Sure, thank you, Shiv, for the detailed presentation. So if any of y'all have a question, please post it on the Q&A window pane, which is there on your screen, and Shiv can take those questions. Meanwhile, Shiv, could I ask you one question from my side? Sorry. I think Shiv, you're on mute. Could you unmute, please?
Can you hear me now?
Yeah.
Yeah, go ahead.
So, Shiv, just wanted to understand from a bidden policy perspective, does anything from the aggression which we saw in the last couple of years from the US side towards China policy, do you see any change in that aggressive approach which has been towards the China trade, or will it remain more or less the same? And from an Indian perspective, are you seeing any particular sectors benefiting from the bidden policies?
That's a very good question. So I think, a lot has been spoken about in terms of his geopolitical and his narrative towards just in terms of foreign policy will be far better and not as volatile as the Trump regime, right? I mean, I don't think he'll be, as I mentioned, tweeting out there on every development. I think he'll be a little bit more commonsensical is the right word. But by and large, I think his China policy, I don't see a major drift in that. That is a legacy in terms of US-China relationships that we will probably not see a major drift. I do think, that he will be in a rush to eliminate some of those tariffs just in the short term. I think he will probably see how much of a hand and what developments China does in that regard as well. But I do believe that I think CEOs in America have gotten the message in the last couple of years with Trump being in power and the US government, being very categorical that they want to shift away from the supply chains being so dependent on China. That is something that will continue. We are seeing the benefit of that in Southeast Asia, Vietnam, Taiwan, some of the other Southeast nations have done extremely well in terms of, winning some market share away from China. We have been kind of slow, unfortunately, but I think, as we have repeatedly spoken about it during the COVID, the next couple of months and quarters provide a great opportunity for India in kind of, being out there and competitive versus our Southeast Asian neighbors. But I think, there's not going to be a massive policy shift from Biden's perspective. And, but his inclination to return the country away from that, Trump America first slogan, right, which was probably that decentralized deglobalization narrative that Trump played out, I think that will change. I think he will have a much more multilateral traditional engagement with not only developed markets but emerging markets as well. And he's spoken about it a bit, but let's see what he actually comes out in terms of the narrative. He has been very positive towards India in his political campaign. He's made some statements, trying to win the Indian diaspora to vote for him as well, which gives us a lot of confidence that, given what we discussed earlier in the presentation, that how democratic regimes have been very beneficial to India in particular. I think that probably will continue to play it out. But as I said, his policies towards India, those 4 points that I mentioned, whether, is he going to be having a, much more favorable US trade policy? What will be his visa policy, his geopolitical support for India versus our neighbors? That is probably what we are watching out for. But of course, the biggest beneficiaries, will continue to be, export-driven industries like tech, big pharma. Are we going to see probably an escalation with US FDA coming in and, as they have been with China, there's US FDA has been extremely critical of the China pharma companies of lately in the Trump political regime. But in the last 1 year, we saw that very favorable trend shift towards India. Does that continue will be something that we are watching out for, but we believe that it will.
Sure, Shiv. Thanks. Shiv, meanwhile, the question queue has started assembling on the window pane. If you could see them, or should I read it out to you?
If you can just read it out, I
Sure.
can't see the pane.
Sure. So the first question has come is which stocks are going to benefit from the re-weight of India on MSCI?
So, I mean, there's a detailed note out there. I don't want to rehash. Please get in touch with your sales representative. And, we have actually come out with a note as well. And I think there are a bunch of stocks there. The large caps have already started reflecting that inflow. But there's a big list, so I probably can't go through it all one by one. But there's a detailed note out from our institutional desk, and we'll be happy to share it. So I'll leave it that it's plain and simple. You can read it at your leisure.
Sure. Shiv, the next question is from Vikram. He asks, will the development of a vaccine imply the beginning of the end of fiscal stimulus?
Not really, Vikram, because the reality is, as I said, the logistical implementation of a vaccine to getting it to 7.7 billion people the world over. And just before getting onto this webinar, I think someone from AIMS sent out an article that the vaccine in India would require storage of at a degree, below a very cold storage logistical movement. So, just implementation of moving the vaccine, and does the virus itself mutate in the next couple of months before we get the vaccine out to people? How does this cold wave, second wave of developed markets play out? These are really big question marks. Do the new political leaders go for lockdowns as they see spikes in cases before the vaccine is actually deliverable? So you're probably, world economy is reopening. Yes, there is a normalization, but are we back to pre-COVID levels in terms of every epicenter industry? No. Right? Are we all going back to movie halls? Are we all traveling? Are we all going to restaurants? So these are questions until you've seen your own life. Are we all going back to offices on a daily basis without any fear? These are the questions that will dictate policies over the longer period of time. And I don't think we are there, at least in the near term. Right? I mean, even before we see a vaccine in India, it could be a couple of months. And I would be skeptical whether we see it in 2021 at all. I don't see it in the first half at least. So the central banks will have to continue to, provide the impetus and the kicker to the economy because, basically, like people have been on ventilators in COVID, unfortunately, the economy needs the ventilator push at the moment still.
Shiv, the next question is what impact will Brexit have on emerging markets, mainly in India?
So Brexit is completely priced in. It's been going on for the last 3 or 4 years. Don't think that markets are looking Brexit from EM lens view, right? It is a completely UK and a European driven policy. I don't think it will have much of an impact in India. Not much of an impact on emerging markets. There are far broader narratives and bigger issues at play in terms of global themes and domestic themes than UK Brexit. So yeah, I wouldn't be too much worried on that.
So Shiv, the next question, which is there on the screen, is what's your view on Japanese economy? Nikkei is at its 20 years high. Do you see a multi-year breakout?
So yes, I mean anyone who's been following Japan, and in my previous avatar, I used to be with the fund in trading Japan very vigorously. So it's a market that I follow very closely, and the reality is I have been very bullish in on Japan, and the reason I say that is there has been at the underlying grassroots level in Japan, the shift towards shareholder minority interest has been phenomenal in the last 2 years, right? When I was trading Japan, there used to be, I would say, almost 10, 20%, 30% of the index. There were companies trading below their cash market value. This is the early 2000s. And the reason for that was there was a massive discount put on companies because of the fact that corporate Japan was not very shareholder friendly. So a lot of policies have come in corporate Japan, and I think that is continuing to play out. The Bank of Japan has been on a zero trend or a negative yield trend for the last 10-15 years. Bottom line is I think the Japanese economy will continue to benefit along with global growth, and I think it will lag the emerging market, but I'm still very bullish on Japan.
Sure, Shiv. I think this is the last question. Where do you see gold in 3 years in USD terms?
I wish I knew, but as I said, I remain very bullish, irrespective of where it ends. I think it will, from an absolute level and from a relative level, given the money printing that we are seeing in the world globally, it's an asset class that protects your, it's an inflation and a deflation trade both. So without getting into the merits of a debate of holding gold, I'm extremely bullish on the gold miners. I think gold as an asset class, especially from a holding some of these large producers in Canada, in US, and Australia, their cash costs have been very stable. So any kicker in the gold price will provide them multi-bagger returns, and you're probably seeing that play out already. But if I have to take a guess, in the next 2-3 years, we'll probably see gold above 3,000. And I mean in dollar terms. So gold today is 1880, 1885. I'm seeing it above 3,000.
Sure, Shiv. I think Shiv, your presentation itself was pretty detailed and covered most of the things, and thank you for answering so many questions as well. It was very insightful. Happy to have you on these webinars, sharing these insights every time. So we look forward to having you again very soon. Thank you everyone for joining in, taking out time for this webinar. Anything, Shiv, from your side?
No, thanks a lot. Stay safe, stay healthy. Wishing everyone a happy Diwali. It's a very auspicious time of the year, and stay healthy and stay happy. Thank you.
Thank you everyone for joining in. Wish you and your family a very happy Diwali.
Thanks, Depan. Bye.
Thank you. Bye.